I'm Roger Baker, Executive Director of the Stratfor Center for Applied Geopolitics at RANE, a global center of excellence for geopolitical intelligence and analysis. Learn how you can put geopolitics to work for your organization at ranenetwork.com.
Hello and welcome to the RANE podcast series. In this episode, founder of RANE, David Lawrence, sits down with President, CEO, and co-founder of KBRA, Jim Nadler. Over the last 30 years, Jim has held several executive positions in the financial analysis arena, including mainstays in the ratings industry, as well as independent research firms. From 1989 to 2001, Jim worked at Fitch Ratings and was instrumental in the growth of Fitch's structured finance area. He began his career as a senior accountant at PricewaterhouseCoopers before moving to Standard & Poor's, now S&P Global Ratings, where he worked as a ratings officer. Jim is the board chairman of Deal Vector, serves on the board for the New York City, Long Island chapter of Breakthrough T1D, and is an elected member of the Economic Club of New York. Let's dive into the discussion. We hope you enjoy this podcast.
Jim, again, thanks for joining us. Follow-up conversation on the topic of private credit, and particularly appreciate the opportunity to speak with you today following last week's announcement by Senator Elizabeth Warren, who is, I think, the ranking Democrat on the House, on the Senate Banking Committee, where she's requesting information from various rating agencies about how they assess the risk of private credit products. You know, she cited to the potential risks to the financial system, obviously mindful of the financial crisis of 2007 and 8, and was actually calling for stress testing of the market and the rating agencies, and I believe similarly wrote to Treasury Secretary Scott Bessent to express her concerns. So this has been put out in the public domain, and I can't think of a better time to speak with you and understand what's going on in the markets, and also how you think about Senator Warren's letter and request for information.
Thanks, David. I appreciate being on again. It's great to catch up, and this is a important topic, A, for rating agencies, and B, for the market. And so I'm happy to dive right in and give you my thoughts on it.
Great. And I say that mindful that it was just about a month or two ago, we did a podcast on the private credit markets, where I thought you did a great job of explaining what private credit is. And so, you know, for our listeners, I would we'll post the link to that prior podcast that you did. So, Jim, as the honest broker that you are around information, tell us what's happening in the markets. And, you know, obviously nobody wants to inadvertently sort of find ourselves in another financial scandal. But maybe you can talk about the role of rating agencies and what's happening in the market. And obviously, Senator Warren's letter was picked up by all the leading media sources and, you know, has resonated. So tell us a little bit about what's happening now, and also the role of the rating agencies with respect to private credit.
Thanks, David. You know, it's interesting, and we talked about in the last podcast that there's just, you know, there's a lot of misinformation about private credit, about private equity in the market. And I think that Senator Warren's letter reflects both the legitimate concerns that the market has, but also reflects the sort of lack of understanding of the private credit landscape and everything that is going on. And I'll talk a little bit about that. So just to go back and briefly talk about how we got to this point in private credit. If you recall, after the financial crisis, there was this concern that banks, because they're heavily regulated, had the regulators needed to understand better and have a better assessment of the things that they held on their balance sheet. And so Dodd-Frank really pushed banks to rid themselves of riskier assets. And the reason that was important is because those risky assets, when those assets got into trouble, banks didn't have a lot of tools at their disposal to work out those loans. What they often had to sell them at reduced prices and in fire sales, and that then created sort of a downward spiral. And so there was this recognition that, we had this sort of problem every so often with banks, that they sort of had risky assets on their balance sheet, got pushed. Those assets got into trouble. They had to sell. Then there was sort of a downward spiral, and so Dodd-Frank pushed these assets out in the market, and the goal was to put them in the hands of unregulated institutions, and to more widely diversify the buying base, which happened, and put them in the hands of investment vehicles, whether it's asset managers, PE firms, or lending platforms, that had more tools at their disposal to work out situations where we have a problem in a particular loan or a particular company, and they can extend the loan, they can restructure the loan, they can they a number of things at their disposal to work the loans out rather than sell them at a fire sale, and thereby retaining value and not creating systemic risk. And so one of the things that's been ironic is this idea that these assets being in the hands of asset managers and private credit creates systemic risk, when exactly the opposite is what has happened. We've taken those assets from a group of institutions where it did create systemic risk, and we put them in the hands of a more diversified group of buyers and owners and holders that can, as I said, have more tools at their disposal to work with these different assets, whether it's loans or ownership of companies. And so so this idea that we're somehow creating systemic risk is just the opposite is happening. Now, that said, as with anything, anytime you see an idea like this take off, it grows and you get it attracts new players, and in order to enter a market, you see people doing different things to try to attract business. Sometimes they can cut corners, and you have new entrants, they try to cut corners to get in, and that's where the rating agencies come in. And so the rating agencies have to be the guardrails that maintain standards in these industries, and particularly new industries like this. We've seen this work very well in the past, and we've seen it go horribly wrong, as in the case of the great financial crisis, where the rating agencies really abdicated their responsibility in the name of their own business interests. And one of the things that I think makes us uniquely situated to be the sort of lead rating agency in the private credit space is that we were born out of the financial crisis. We started in 2010, and the goal, Jules Kroll had this idea, and I very quickly met him and got on board with this terrific idea that he had, that there had to be a better way to for rating agencies to work with the market, and that rating agencies really had to do a better job. They had to be the guardrails for investors, and so because of that, it's really in our DNA, and so I think we're uniquely situated to work in the private credit space. But more importantly, I think it's why investors have made us the leading rating agency in the private credit space, because I think they trust us, and they trust that we are going to be we are going to maintain those guardrails and maintain the credit quality of the assets in the private credit space.
Okay. And I assume, at least as I read the release from Senator Warren's office, we'll call it, the book of Ecclesiastes moment, Jim. There's nothing new under the sun. It's all been said and done before. That the concerns here would have to do with the objectivity of the ratings that are being applied, the I'll call it the protocols and discipline in terms of the analyses, and obviously avoiding conflicts of interest, all of which were seen as part of the cause of the financial crisis of 07 and 08. And as you look out in the market, and I'm interpreting this a little bit, there has been a lot said about opening up to the retail public access to private credit. It's not just for sophisticated investors anymore. There's talk about opening it up for retirement accounts, et cetera. And so Senator Warren, who had a significant position on the consumer protection side, in her role as an agency head in Washington, I'm reading sort of her request for information, as obviously it picked up a lot of news and media attraction, but that these are the principal things that she is focused on and concerned, because investments in private credit are spreading. She's not alone. Jamie Dimon has spoken about this as well as others. And so just in terms of the market and what you're seeing in terms of what are people getting right about their understanding of the marketplace, what are they getting wrong about the marketplace, maybe you can share some of your perspectives on this. And I'm going to ask you maybe to sort of step out of your role as leading KBRA, the leading rating agent, one of the leading rating agencies, and just say, okay, what should people be focused on, both as investors, as regulators, and with the notion, as I've heard you speak, we all have an interest in protecting people and what I'll refer to as the long-term sustainability of this market.
That's a great question, David, and let me just reframe it a little bit. And so we've always been concerned, whether it is stocks or Bitcoin or other assets or instruments, financial instruments. We've always been concerned that when they're offered to retail investors, we want to make sure that the retail investors have the ability to understand what they're buying, and that the instruments being offered have the same, sort of veracity, or the same sort of creditworthiness that they would have if they were offered to institutional investors. So there's a couple of things. So let's take 401k plans, for instance. So 401k plans are heavily regulated, and in order to believe that private credit is going to be a bad thing for 401k plans, you have to believe that the rating agencies are going to all of a sudden lose their standards, that the regulators that regulate the firms that provide investment advice and provide investments to 401k programs are going to all of a sudden, you know, not do the same sort of rigorous research and assessment that they do for all other investments. And so I think that in and of itself, we have to sort of make sure we understand what really is happening. It's not as if I think there's this idea when you hear this that, there's going to be some guy on the street corner selling private credit to anybody that walks by, and that's not what we're talking about. We're talking about heavily regulated industries and private credit being offered through reputable vehicles and with the same sort of scrutiny that that was given to these instruments when they're offered to institutional investors. As with everything, you always worry about the investor and are they equipped to understand what they're buying. One of the hallmarks of our financial markets is the democracy in our financial markets. You can buy stocks if you can get an account and you can invest in stocks. Nobody gives you an IQ test. They assume you're going to be investing in stocks that you've researched and that you're doing it in your own best interest. And so yes, people will make mistakes. Now, it's incumbent upon the regulators in those instances to use the same tools that they have available to them to make sure that there's adequate information provided and that the potential investors have adequate means and adequate and can understand what they're buying. And so I guess I have more faith in the systems that we've set up, that I believe that this is going to be done in a way that makes sense both for the companies that are offering these opportunities as well as for the investors, whether it's a 401k investor or an IRA investor. And so do we again have to make sure that as a rating agency that we're being vigilant and that we're using the same standards that we use in each of these different types of structures? Absolutely. But I think that I think there's a lot of misinformation about what it means to begin to offer private credit in these situations, and we have as far back as the 1930s, we've set up regulations around this type of activity, and those regulations have served us well. For not perfectly, but they've served us well for nearly 100 years.
So you've touched on a number of themes. One is the democratization of investments and allowing people to invest in a new class of assets, hopefully with sufficient protections. But as you say, investors make their own decisions. They're often influenced, as you know, Jim, by talking heads on TV. And advertisements. I can't help but note the number of online and television ads there are these days about gold and silver and protecting one's wealth, etc.
David, it's funny that you mentioned that, because I'll tell you a funny story. My my father, who recently died, he great guy, lived a nice long life. He and my stepmother called me one morning from their car, and they'd been watching CNBC. And my dad, successful small business owner, but he called me up and he said, Jim, we were reading that we needed to be invested in dollars. How do we do that? I'm like, Dad, your whole life is dollars.
Right.
You're ahead of the market here.
You're long dollar.
You've
You're
done
long the U.S.
it.
dollar. Right. Yeah.
Exactly.
Yeah.
And so the reason I tell that story is a little bit to make fun of my dad, but the reason I tell that story is you're right. I think that people get influenced by a number of different things, and certainly listening to CNBC and Bloomberg and people hear about opportunities, and when it comes to actually being able to invest in them. And you do as an investor need to ask the right questions, but I think that's where rating agencies have a very important role on rated products in the whether it's in 401ks or in funds. Um, we have to use the same methodologies, the same criteria, and the same rigorous attention to detail that we do for any other, regardless of who the investor is, so that those retail investors can rely on the rating agencies to have applied the same methodology. Now they still do need to do their own work, but they can rely somewhat and take some comfort from a rating in those investments.
I have a. This is maybe for a separate podcast, Jim. But in light of the alternative asset classes that are being offered to the public, um, um, no one. I haven't heard anyone calling for ratings on the various digital coins that are being sold to people and people are investing in and trading. No less the repositories that are supposedly holding these coins. And in similar fashion, as more so-called alternative assets are being offered, I couldn't help, and I'm not trying to simplify this, but the term private credit is it's a very ingenious marketing term. Okay, it sounds like it's something new. One might argue that if you wanted to invest in private credit, there are a whole bunch of bonds that you could buy, or a portfolio that you could assemble, or a mutual fund that you can invest in. But this is, as you say, there's a new asset class, and it represents the democratization not only of for investors but also for companies that are seeking to raise capital. And so, talk to us a little bit in the time we have remaining. What exactly does a rating agency do when it looks at private credit? What are you looking for? Where are you kicking the tires? And maybe phrase it another way, what does the eventual rating depend upon?
So very interesting that you bring this up, and it's very timely. So I'll start by saying I think that there's a general private credit is a fairly broad term, but included in that are and often sort of mixed in with this is this idea of unpublished ratings, meaning that rating agencies do a rating for an issuer, and it's going to be bought by a single or a small group of insurance companies, and they don't go through the public markets. It's done privately, and the ratings don't get published and the research doesn't get published. And there's this idea that, and I think this gets caught up in the private credit uh, market as well. There's this idea that rating agencies somehow do something different when they're looking at these. They're easier. They do all this nefarious stuff. And it's very interesting because we just published a paper looking at our published ratings versus our unpublished ratings, which typically sometimes are called private ratings. And actually, the private ratings were more stable. The unpublished ratings were more stable than the published ratings. We used the same criteria, we used the same rigor. Um, it was, I think we were expecting them to be the same, and I think we were surprised to see that the unpublished ratings were slightly more stable than the published ratings. And to me, the takeaway from that is that, you know, issuers and investors, there's maybe a bit higher quality in those, or a bit more rigor. The rating agencies do the exact same work, they use the same methodology. But for me, I think it put to bed this idea, this notion that there's something secretive and worrisome in the unpublished market. And I think that's been the implication of some articles that have been written. It's been I think it was the sort of the backdrop to Elizabeth Warren's record. And I think, like everything else, we as a rating agency believe that sunlight and transparency is the best thing we can do in any market. And so making sure that we're starting from a place where we all have the same facts, we're all dealing with the same facts. And then we can think about, are there things that we can do better? Are there things that we should be working on collectively to make this market better? Because there's always opportunities for growth. There's always opportunities to do things better. But we have to start in a place where we're all using the same facts, and we cannot start in a place where we have wildly different assumptions about the market and expect to get to a place where we're all going to agree on something. And so my biggest ask, or my biggest, I think, task as a leading rating agency in private credit, what I spend most of my time doing is trying to get people to understand the facts of the market and then begin our conversation about the market from that basis of transparency and facts. Then I think we can have really great conversations, whether it's with a congressperson, whether it's with a regulator, an investor, an issuer. Um, we can have great conversations about moving this market forward in a really healthy way. And we can have great conversations about the things we're all worried about, and we can talk about those. But it is critical that we all start with the same set of facts, and we don't use opportunities to um, uh, you know write a piece because it's going to get a bunch of clicks, or send a letter because it's going to be great for my base. They're going to love this. I think that's disingenuous, and I think that does more harm to the industry. Last thing I'll say about private credit that I think is just so misunderstood is the one of the many reasons that the United States is a leader in ingenuity, inventiveness when it comes to different businesses, is because of the different ways in which business owners can raise money. Private credit being a big part of that landscape. It's also, when you think about it, one of the most important things about our banking system. We have 6,000 banks versus a country like Canada that has 6 banks, 7 banks. And you look at the number of startups in the United States, whether it's a mom and pop haircut place or a mom and pop laundromat. And a lot of times it's because those people can get loans from a bank based on real estate that they own to start their business. And so I think that the what gets lost in all of this concern is how important each of these aspects are to the power that the U.S. has, the economic power that the U.S. has, and continues to have, and continues to lead the world. And I think that, again, I go back to, if we're going to have a conversation about concerns in any of these markets, let's start with the facts and make sure we all have the same facts, and that we're being transparent about what we want out of the conversation. Then I think we can have a really healthy conversation and get to a great place. It's what I spend almost all of my time doing when I speak to people.
So let me, first of all, some great points. And again, I just have to point out, and I'll commend the fact that KBRA is so self-aware and self-reflective that you decided to go back and look at your public ratings versus your private ratings to see if there was something there that you should focus on. That sounds tremendous. And as I hear you talk about the importance of having a common set of facts, one of my favorite quotes, I use it a lot, Jim, is the quote attributed to the late Senator Daniel Moynihan and professor, who once famously argued to a senator, "Sir, you're entitled to your own opinion, but you are not entitled to your own set of facts."
It's true. I love that. I love that quote.
Okay, so
It's
yeah.
one of the best quotes, and I think it's important for people to keep that in mind when they're thinking uh, about and what they really want. What do you really want out of a conversation? Are you just trying to make a point for other reasons, or do you really want to get to a solution that's going to work?
So Jim, I don't want to go down to the rabbit hole of Washington D.C. and assigning ratings to our elected officials. Okay, which wouldn't be necessarily a bad idea. But I'm watching the clock because in the few minutes we have left, maybe you can just go into the specifics a little bit about what you look for within a particular credit in order to assess its rating and its, I'll use the word suitability for the marketplace.
I think and again, I will admit that it has been a while since I have actually been an analyst, and so I'm actually
Jim,
the wrong
you
person.
continue to sleep in a Holiday Inn, so I
Yeah,
know
yeah,
you're on top of this. Go ahead.
yeah. But I will tell you that we, one of the things I'll point to is we publish methodologies on everything that we rate. Those methodologies are detailed, and we must follow those methodologies in everything that we rate, and it is very easy for investors to read our methodologies. They're very readable, and if they have questions, you can get to one of our analysts very easily. You just pick up the phone, we answer our phone, we if we're on another line, we call you back. We're happy to walk through the analysis. We also then surveil these issues on an ongoing basis, and we provide updated information about each issue and how they're performing over time, how we expected them to perform, and how they're performing relative to that expectation. We go out of our way to make it easy for investors. For instance, we rate a number of business development corporations. They're called BDCs. They're part of this, sort of what's called the shadow banking system, but the non-depository banking system. And, and we realized that investors were spending a lot of time every quarter trying to get, information together. And so we started providing, and now we do that on an ongoing basis, a compendium of all of the BDCs that we rate once a quarter. It's a one-page snapshot of how that BDC is performing every quarter. And so not only do we take great pride and great and spend provide great rigor in the initial rating of any asset. We go out of our way to make sure that we're providing rating agents to providing investors with the information they need and making it easy for them to get that information and be able to use it.
I'm glad you're making these points, which is a snapshot of the creditworthiness of a particular asset is just that. At a particular point in time, conditions change. They can get better, they can get worse, they can remain status quo. And the fact that KBRA is doing that and providing that information to investors, critical importance. Secondly, the fact that your methodologies are transparent, of critical importance. And particularly as individual investors are going to be relying on another layer of professionals to do the curation and the selection of the assets that that the investors in turn will be investing in. The fact that you're doing this and making this accessible, Jim, critical importance, obviously to investors, but broadly to protecting the integrity of the marketplace. And just in terms of reading some of the things that have come out of Washington, I'm not sure that the regulators and various elected officials have a full appreciation of everything that goes into the process of rating these assets, or at least may not have a full appreciation of everything that KBRA is doing. So thanks for doing it. And I know a lot of the initiatives that you undertake to ensure, I'll call it the integrity of the rating and making sure that an asset is accurately reflected at a particular moment in time. It's not necessarily being driven by a specific regulation, but in large part, KBRA's lineage, why it evolved. You're anticipating what is actually needed in the market, and quite frankly, anticipating what regulatory concerns are out there even before they're articulated. So,
well, and David, just on that point, let me point out, and it's because we listen to investors. We get our strength from investors.
Yes.
We spend the most time with investors, and that's how we can get ahead of regulatory concerns, is because first, they're an investor concern,
right,
and we can address them with investors. And so I'm glad you pointed that out. That was.
And I also know you guys do pretty good autopsies when things go wrong in the marketplace to understand what went wrong here and what was missed. So yet another benefit to your methodologies.
That is absolutely true.
Okay. All right, more to come. Jim, thank you very much for the time, the insight, and like all great ideas, let's keep them great and let's make sure they're not subject to shortcuts and misuse. But the point you made about what makes this country great, and I've long felt this and why we attract people from all over the world, the ability to have an idea, the ability to protect that idea, the ability to raise capital, and build a business around that idea, and to expand and scale and create wealth for many people is one of the hallmarks. But it requires a marketplace where people can access capital. So the point you've made about private credit is really a great one as well. So thanks for the time, Jim, and really thanks so much for the perspective.
David, thanks for having me. I enjoy these.
Thanks for listening. Check out Jim Nadler's full bio and KBRA's company profile at the link in the description. Want more RANE content? Be sure to subscribe to the RANE podcast series today, available on all podcast platforms. Or visit our website at ranenetwork.com. That's RANE network.com.